Joining us this morning from Des Moines, Iowa, we have Jeffrey Schwarte, portfolio manager at Principal Global, which has more than $250 billion in assets under management. Jeff, good to see you. So first off, let's touch on Bernanke, shall we? Because he was talking to ABC News and talking about basically we still have a long way to go in seeing this full recovery in the U.S., but he's sleeping better.
Well, certainly there's been some positive developments from an economic perspective related to employment growth. Has certainly been stronger than people had expected, with 227,000 jobs in February. And we're in our 10th consecutive week of initial unemployment claims below 400,000. So we certainly have recovered about 750,000 jobs, but we certainly have a long ways to go given the financial crisis driven by the housing market several years ago.
Yeah, and Jeffrey, the question is, stimulus still on the table, but is he going to pull the trigger on another package of QE3?
Well, it's hard to say. It's certainly in the minds of investors. Some investors would hope for another round of quantitative easing. However, the data as of late does not support that. In fact, some investors are concerned that it would create too much inflation and cause problems for consumption. But as of right now, the economic data has been positive relative to manufacturing, consumer confidence, and the housing market tends to not be a headwind right now, but we certainly are seeing positive trends in those aspects of the market.
Yeah, especially as this week we closed down the first quarter, and what a quarter it's been, the best since 1998, a bit of window dressing as well to shut it all down. Are you changing any of your positioning going into Q2 at all?
No, we're pretty happy with how we're positioned. In fact, it's been the 7th strongest start in the equity market since 1928, so a very, very strong quarter. We continue to favor 3 areas of the marketplace right now. We continue to like technology. We like what's happening with mobile devices and the enterprise spending on storage. We would highlight 2 stocks there, Apple and Broadcom, as being examples of stock picks we have in that particular sector. The second area that we are favorable on is the consumer. We continue to see trends very favorable for the high-end consumer. We're favoring Macy's at this point, as we're seeing strong demand for shoes, handbags, and jewelry. The other area within consumer discretionary stocks that we're favoring is we are seeing demand for home improvement, whether it be carpet, paint, windows, those types of things. We are seeing favorable trends given the 6 to 7 million homes that are in distressed properties. Those have to be improved upon before we're going to liquidate that inventory. And I guess the third area that we've been positioned thus far that we're favorable on is financials. We're first time in 3 years we've been overweight financials. We've got bank stocks. Most of the bank stocks we own did pass the stress test of a few weeks ago, and we continue to see favorable trends with consumer credit card stocks, specifically Discover Financial, as they broaden their credit card offering to include mortgages and student loans and checking and savings. So we're continuing to be cautiously optimistic on the trends that we're seeing, and I think a lot of investors have been surprised how resilient the market has been over the last 6 months.
Yeah, it has been resilient, at least in the last few months or so, bouncing off those October lows. But Jeffrey, haven't we seen this story before? I mean, didn't last year kind of start out the same? We came out with a lot of steam into the first quarter, into the second quarter, and then it really just fell off a cliff going to the last 6 months. Do you think there's any threat of that happening again this year?
Well, one of the concerns that's at the top of investors' mind right now that wasn't there last year is the higher energy prices. We are seeing oil. The prices at the pump approach $4, which we saw back in 2008, around July time period, in which we did see a nonlinear relationship. As the price of oil goes up, we do see an impact to consumption. We are reminded that last year we did have some key events that did impact the market. We had the disaster that occurred in Tokyo with the earthquake and tsunami, and then in third quarter of last year we did have the failure of super committee and the acceleration of problems in Europe. So barring any sort of negative tail event, we continue to see positive trends for equity investors in the U.S. market.
Yeah, a quick question for you. Concerned about China slowing down at all? That's a risk as well.
It is a risk. We are seeing expectations drop to about the 7.5 GDP level. We are watching it very closely because about 10% of revenue for the S&P 500 does come from emerging markets, and China's about 8% of that. So we are watching the situation very, very closely, as we are the situation in Europe. So given the events that have occurred and the economic data that's positive, we are still cautiously optimistic about the U.S. equity markets.
Hey, Jeff, good talking to you today. Thank you so much for your insights.